Thank you for having me.
We are the closing act here.
Yeah,
so
exactly.
Thanks to everybody for
Sticking around.
staying all day. And let's jump right into it. You manage some very important pensions, the pensions of some of my family members who are Ontario teachers. You've talked about putting more emphasis within the organization of making sure the investing team is focused on like what's our edge. If you're taking active risk, there needs to be an excess return and so on. And I'd like you to start by delving into that investment process thing. What kinds of decisions have you made at Ontario Teachers to focus the team on where's our edge?
Right. Yeah, I mean, edge is one of these terms people use a lot, and when you try to define it, it can get a little bit looser in practice. I think it's important to understand that Teachers has a portfolio that is built out of a foundation of assets, are what we call an all-weather portfolio construction that is really based on being able to manage through different potential scenarios where growth and inflation can perform differently than expected by markets. So that's our foundation of returns. On top of that, we take active risk in areas where we think we have an edge, and that's to the extent that you think you can generate excess returns. So where do we focus? Traditionally, Teachers has been very strong in private asset investing. We were one of the first pension plans to be investing directly in things like private equity, infrastructure, timber assets. There were a lot of innovations in the Teachers portfolio, and so we had some first mover advantage there. I'd say some of that translates into edge today in the sense that we have the capabilities to invest in these asset classes. We have a long history of being there, and so we're somebody who tends to get calls by people who would like to partner on various assets, so it puts us in the flow there. I think having the pool of assets that we have and the history of investing also means that we've partnered with other organizations over the years. We invest through funds as well as directly, and so we have access to a lot of smart funds, smart partners for assets. And so again, that helps us both be able to see what interesting sectors, geographies they're focused on, what their pipelines look like, what their fund age looks like, what kind of assets are they interested in buying or selling, which can help build flow for us. So we think about those things in terms of the business. Now, I think some of these markets have become more challenging for, I'd say primarily just because of the reset we've seen in real rates over the last couple of years, and that is still pricing through markets. And so we have to be sort of looking carefully in the mirror around what has changed in these markets and how does that impact our edge or not. So if I can give one example would be our real estate, we had real estate managed externally by a Canadian owner and operator of assets, Cadillac Fairview. And as we were expanding our real estate portfolio into globally, I guess, so into other regions, and also it was predominantly office and retail focused, and we wanted to get more sector breadth there. So we asked Cadillac Fairview to do that for us. Now, that was not their edge. Their edge was developing and operating properties in retail and office in Canada. And so we made the decision beginning of last year to bring real estate in-house because we want more of that investment focus. Both you should be a buyer and a seller at any price on any asset, right? Not really attached to the assets you hold, and we felt that was best managed within an investment total portfolio construct within Ontario Teachers, and so brought real estate in-house for that reason.
Let's talk a bit about the environment in private equity, because of course we had the shock of rates a few years ago. 3 years ago at this event, we were talking all about interest rates.
Yeah.
Then obviously that pressure has lessened, but other pressures have come in. So give us your sort of taking stock of what the opportunity set looks like for you as a large investor in private equity.
Yeah. I think, interest rates are certainly part of the picture there. I think private equity has been a very successful investment strategy for many years for lots of different investors, for us as well, both directly and through funds. What we've seen is that with the reset in interest rates certainly impacted the ability to leverage the assets you own and generate higher returns for higher risk, but generate higher returns out of those assets. I think we also saw a real re-rating of multiples in privates versus public markets, where private multiples had started to become quite highly valued. You know, there were some pretty high multiples through the post-COVID low rate flush into private assets. And so when you're modeling private equity, I think you have to understand what the drivers of your return are. And to the extent that interest rates or leverage and multiple expansion was part of that calculus for your expected returns on assets, you have to recognize that those just aren't providing the same tailwind that they might have in the past. With that, I think the question is, how do you generate returns out of private assets? And for us, that means refocusing on actually the operating company level results. So how do you drive revenues, drive efficiencies in companies? And so we formed a group within Ontario Teachers. We took some asset management professionals from across all the different asset classes and brought them together into a team called Portfolio Solutions. And so that team now sits with our deal team from the moment they're looking at an asset and working on the valuation, both to buy that asset, but how are you going to drive value over the life of that asset and sell it? And they sit with the deal teams and go through, these are the 5 levers of value creation we're going to focus on. We think we can take this measure from X to Y. If we do that, it will create X amount of revenue or reduce cost by X, and that will be the driver of the returns. And so there's a much more of a, I'd say, getting back to old school private equity, where you're actually improving operating performance versus being maybe as focused on financial engineering in private equity.
In terms of fund investing, some of our reporters have heard that some non-U.S. LPs are starting to price in higher risk when investing in U.S. domiciled funds. Mm-hmm. Is that the case, whether they're private equity or hedge funds or whatever it may be? Is that the case for Ontario Teachers?
No, not. I wouldn't say there's like a pricing for U.S. Every asset is assessed on the risks of that particular asset. I think when we recognize that there's more uncertainty or a wider range of potential outcomes over an asset that we hold, you're going to price that in as increased risk and ask for an increased return to that. But I'd say that's on an asset-by-asset basis. As
opposed to looking at the U.S. as its own sort of unique case. Mm. Is it, let's talk about public markets for a moment. Is it possible for a fund of your size to generate excess returns in public equities right now in this environment? And if that's hard, what do you do about it?
I think it's hard to be clear. It's hard for any fund to outperform, let's say, S&P 500 public market returns, which have really been incredibly strong over the last couple of years. And that's true for public or private assets. It's a hard benchmark to outperform. We still have conviction on the private side that over a cycle, we should be able to generate excess returns over public markets. Our experience, and this goes back to the earlier question around how do we define our edge, know where we can actually build conviction and add value to the pension. When we look at public markets, it's something that we've approached from multiple angles over the years, and we have not found a real sustainable angle in that kind of fundamental public equity investing where you have a sort of a better grasp of the valuation of a company than where the market, happens to be settling in terms of a clearing price. And that, I think, is just, public markets are, in the U.S., quite efficient, right? You've got a little bit of this tension between, if you want inefficiency in markets, you have to go to less liquid markets. So by definition, there's less that you can scale there, right? And so there's going to be some tension between where you can find opportunities. I think some investors do better in that space. It's something that we haven't had a lot of success in. We still have success internally on a quantitative basis, investing equity long-short programs. And I'd say also we see partners like through our external managers, hedge fund partners who are very good at exploiting, I'd say, more deep expertise in inefficiencies between very distinct pairs of stocks, et cetera, where you can go both very deep but also trade at a much more rapid pace than what would suit us in terms of our internal investment strategies. And so we still have that risk. We've just tried to figure out where is it best that we can do that investing directly versus give it to an external manager.
Right. So speaking of that internal, external, let's talk about private credit. How do you guys handle it? Where are you focused, and what's the stuff that is, in the we're not interested category?
So in private credit, it's something that we had a presence in that market, I'd say, for many years, just quite small. It was something that in 2020-ish, like I can remember, it's that, COVID from like when you were at home for long periods and having all the video calls. It was all video calls when we were talking about starting a private credit mandate. We initially got exposure through funds because, again, lean on your smart friends who have the origination networks. They have the ability to work out distressed names, et cetera. Where were we going to build those capabilities besides sitting beside a partner and learning with? So we started with fund allocations. I'd say over the last couple of years, private credit is as an asset class, it has improved in the all-in yield side, but the spreads have been fairly tight, and we think of it as a spread product more than an all-in yield product. So as that came in, and you're sort of still paying external managers the same kind of returns over hurdle rates, that hurdle rate is now being assisted a lot by just base rates rather than actual outperformance. And so as that kind of shift between the value for dollar, I guess, to external managers started to shift, we started bringing in more and more of that capital and hired up a team to manage that. In terms of where we go or don't go, our credit team manages across the spectrum of public to private. So the opportunity set is very broad. I like that because it means we're always calibrating those two markets, one to the other, and making those choices about which market is better priced than the other. I think issuers seem to be increasingly going to both markets simultaneously, or certainly comparing between. And so we feel it positions us well to be competitive in that market. The only area where we don't tend to play is really in the investment grade space, which again I think turns into more of a duration rate product rather than a spread product. So we don't tend to do a lot in that space because we don't see it as being a good source of excess returns without sort of excess leverage to get to the return hurdle you need.
All right, I've got, in the time we got left, 2 AI-related questions.
Okay.
Yes, the first is about the market environment, and I'll avoid using the word bubble, but is the space overheated in public markets?
Is it overheated? I have a colleague who says like the overheated stocks can keep on getting overheated, whether you call them that or not, it doesn't really matter. I mean, I'd say it's a point certainly of concern. Valuations are pretty high. We do take stock against, these are companies that are generating cash flow. So, people make the distinction to the kind of internet bubble in 2000 where we're not at those kinds of PEs by any measure because these are real companies making real earnings. It's a big CapEx spend. It's something that we as a fund have aligned with in terms of the data center space where we've been invested in the development and operation of data centers. And also certainly in the energy space where we have a fair amount of investment in the generation and transmission of electricity, which is one of the big needs for the AI piece. So I'd say we're trying to be thoughtful about where we play this space and where we think the risk reward is better and where it sets up better with our skills, frankly.
All right, and so my second AI question is about how you use it and how the people on your investment team use it within your investment process today, and where might you be going with it? Yeah,
we use AI internally. I think it's as good as the data that you can feed it. Our data has not been, on the private side, it's not been something that we have ever built or with a view to let's make this accessible to AI. And so we're playing a bit of catch up there and trying to get our data into the shape we want it to be able to point it to 35 years of investing, right? There's a lot of pattern recognition value that could be generated out of that. So we're excited about that. I use it now, certainly when I'm scanning through emails, when I'm prepping for my week, when I think about the concerns I have that I'd like to scan through what underwriting committees are looking at and get a sense of where the whole fund is going. So I use it quite heavily. I think our teams are using it a lot in some of the very early stage of looking at market scans, et cetera, where they might have gone to consultants outside. They can do some of that internally now. And then obviously the big concern for us is we're a big holder of private assets and making sure that we're looking at that portfolio of private asset companies and considering who's going to be disrupted here and who has an opportunity for better returns, and trying to get ahead of the disruption and align our companies with the return opportunity.
Have you made any specific moves yet on the basis of that concern, that you hold
Yes.
things that...
I'll say yes,
Yes.
and leave it
All
at
right. You care to...
No details to share, and
All
yes.
right. All right. Well, we'll read your next annual report with interest, and thank you so much
Absolutely.
for taking the time today.
Thank you very much. Thanks.